Thank you so much for coming along. Hello, and welcome to the BuytoLet webinar today. My name is Karen, and I work on the ESPC marketing team. With us on our panel today is Stephen Fell from Malcolm Jack, Nikki Lloyd from ESPC Lettings, and Paul DeMarco from ESPC Mortgages. We will be answering your pre-submitted questions, so thank you in advance for submitting those. And if you have any questions at the end or throughout the webinar, just pop them in the Q&A box at the bottom of the screen and we'll do our best to get around to them. Feel free to ask questions if you want us to expand on anything, and we've done our best to group the questions together. Some were duplicates and some we can cover under the one question to get through as much as possible. But like I say, if you want any more information, just ask and we'll do our very best to get around to them at the end. And of course, if there's anything that you want more information on, please feel free to email myself at marketing@espc.com and I can pass you over to the relevant expert. Okay, so to start off, we will go to Nikki, who will give us a market overview.
Thanks, Karen. Hi, everybody, and thanks for joining us today. So I was just going to give a little bit of an update on the rental market and just to let you know what's been happening since really the start of the year. So if this is something you're interested in, you'll probably know that it's been pretty busy in the rental market. Certainly right since the beginning of the year, we have seen high demand from tenants, which have led to kind of increase in rents, time to let rapidly kind of declining, and all whilst really stock levels have been at an all-time low. So we're kind of, as we move along into the spring and summer, which are historically our busiest time of year, it's only going to get more and more busy, I should imagine. So just to give you an idea, across Scotland as a whole, there's been definite positive growth in the rental market for all property types, with the average rent across Scotland now at £869 a month, with most properties letting within 20 days, and 46% of one beds are let within a week. Just narrowing down those figures a little bit for Edinburgh. Again, Edinburgh is seeing fantastic growth. We're now an average monthly rent of £1,191 a month. Properties are taking an average of 17 days to let. Again, one bedrooms being the quickest to turn around at just 10 days. But we've really had instances where properties have been put on the market and just snapped up within kind of hours of them going live. And that's all types of properties. So it's a really keen market at the moment. We're also finding that tenants are staying longer than before. So that's maybe partially responsible for the low stock levels. So tenants are staying longer, so properties aren't returning back to the market. But that's good news for landlords. They've got tenants that are happy. There's a high demand definitely for good quality properties. Tenants are willing to pay rent, providing the properties in good order. So given that there's been substantial growth over the last 10 years, despite everything that's happened, it still certainly makes it a pretty good, attractive option for long-term investors. And as demand is continuing throughout the rental market, then buy-to-let investment certainly looks like an exciting place to be over the coming months. So yeah, it's a pretty good place to be just now.
Brilliant. Thank you so much, Nikki. Okay, so we'll go ahead and move on to our Q&A. Just a reminder for those of you who have just joined us, any questions that you have throughout this webinar, please submit them in the Q&A box. And if we have time, we'll do our very best to get around to them at the end. So the first question is for Stephen, and it is, could you provide clarity on the changes to council tax for buy-to-let properties? And will HMOs rented to students continue to pay no council tax?
Well, thank you, Karen, and good afternoon, everyone. This is the webinar equivalent of that vexing question you got in maths at high school. You know, the one, if a train's travelling in a northerly direction at 10 newtons and another train's travelling in a southerly direction at 5 newtons, what's the capital of Australia? It's interminably difficult to provide clarity in relation to it, given the nature of the regulations. My presumption, though, is that the question relates to the Council Tax Reduction Scotland Regulations 2021, which, although it has 2021 in its name, just came into force in April this year. The Scottish Government policy document relating to the regulation states that it's an act which is to ensure that as far as practicable, a household in the same circumstances receives the same level of council tax reduction, whether on universal credit or not. And basically it's an act to reduce council tax liability for lower income households. The level of reduction depends on the household circumstances, income, savings, etc. And the reduction can be anywhere up to 100% of council tax. These regulations, though, have been in one form or another and have been in place previously, but the councils have had different methods of calculating the reductions. So this is an attempt by the government to collate all of the different ways that the different councils have been calculating the reduction and to assimilate them into one method of doing so. So that's the background. The Act itself at section 13 says that a person who is liable to pay council tax under section 75 of the Act, and the Act is defined as the Local Government Finance Act 1992, is entitled to council tax reduction under this regulation in respect of a day if conditions set out elsewhere in the Act are satisfied. The relevant person's capital does not exceed the limit set out in the regulations in the Act as well. So there's various prerequisites for it. One thing to note is that the Act and the reduction does not apply to students. They are treated separately. Section 20 of the Act specifies that that's the case. So to bring this round to the landlord and buy-to-lets, I don't think it has much of an effect on landlords themselves. The Act is more to provide some form of help to people that are on lower incomes that are renting properties from the landlord. So it's the tenant that gets the benefit of that. Specific question there in relation to HMOs rented to students, and will they continue to pay no council tax? Well, a property that's let entirely to full-time students is exempt from council tax, and therefore neither landlord or tenant are liable for any council tax in that regard. Just a wee side note of caution though, if one of the tenants is not a student, that could cause problems as the exemption may cease and council tax may become payable. An instance that might arise on a practical level might be if you have a group of students and one of them drops out, stops becoming a student, goes away and gets a job, but stays in the same house, stays in the same property, they're not a student, that will be treated differently, and there's potentially council tax implications in that regard. Okay, hopefully that answers that question.
Brilliant, thank you so much, Stephen. The next question is for Nikki. What cosmetic upgrades do you recommend making on an Edinburgh tenement flat before letting it out?
So as I've mentioned before, just earlier there, so there's definitely a demand for good quality properties. So presenting your property at the best will hopefully maximise your rent and the length of tenancy. So if you have an opportunity to kind of do some upgrading, then definitely I would take that advantage. What we find are tenants most keen on are kitchens and bathrooms. So if those areas were looking tired, take the opportunity to upgrade before you start renting it out. You don't need to spend a fortune. It just needs to be bright, clean, fresh, functioning, basically a space that you would be happy to use. Then that's what I would recommend. If your budget maybe doesn't stretch to doing things like that, then a fresh coat of paint throughout, possibly new flooring, then anything to just lift the property would definitely, I would take advantage to do any of those things. Yep, they're going to attract you hopefully a better tenant and more rent. So if you've got the chance, then some form of upgrading, even if it is just a fresh coat of paint, then yeah, I would recommend that always be done. It encourages your tenant then to keep it looking fresh and clean as well.
Thank you. Paul, the next question's for yourself. How much will a lender allow to be borrowed against an unencumbered property that is being used as both a capital investment and an income stream?
Thanks for the question, Karen. Good afternoon, everybody. Yes, in general terms, you can normally borrow up to 75% of the valuation of the property that you own, the one that's unencumbered. But this depends on a number of other factors, the main one being how much rent you can actually achieve from the property. So obviously, if it's a 1-bedroom flat, you'll get less rent than you would on a 2-bedroom flat. So this 75% rule may not apply. So the maths would have to be done by somebody like myself to work out exactly how much you could borrow. But in general terms, it is 75% of the valuation of the property. Now, what you can and can't actually borrow the money for, I'll give you the no's and I'll give you the yeses, what you can and what you can't do. What you can't do is you can't use it for a business reason, like buy a commercial dwelling, can't do it for paying a tax bill, and you can't do it actually either, believe it or not, for investing in the stock market, or even replenishing your savings. But what you can use it for is to buy another property with it outright, or put a deposit down for another property, gift the money to a blood relation in general, so they can, like a first-time buyer, for example, so they're able to put a deposit down or buy a property outright. Or you can actually use it to pay off another mortgage. So these are the things you can use it for, and these are the things you can't use it for.
Thank you, Paul. The next question is for Nikki. I'm looking to buy a flat near to my daughters in Edinburgh. This person has a few buy-to-lets in England and would like information on the eviction process if that becomes necessary. Is it as complicated as the English system?
So I can't really comment on the English system, but I can certainly tell you how it would work here in Scotland. So the first thing that I would maybe just make clear is the words eviction and notice. So you can serve notice on your tenant, that's not actually the same as evicting your tenant. So serving notice on your tenant is when you want to regain possession of your property. You serve notice, you need a ground and an end date to the tenancy. That is serving notice. If your tenant doesn't move out at the end of your tenancy, then you need to move to eviction. So that's the next process. So serving notice initially, and then if they don't move out, you're on to the eviction. In terms of serving notice, it will depend on the type of lease that you have in place with your tenant. So if you have signed a lease anytime after December 2017, it will be a private residential tenancy. These tenancies are not for any fixed term. They have an end date, sorry, they have a start date, but no end date, and they're not for any fixed period, as I say. So you can serve notice on your tenant, but you do need to have a ground on which to serve the notice, which is slightly different from the short assured tenancies we had previously. So a ground can range from anything from you wanting to take back the property to sell, to move back into yourself, or a family member wants to move in, or you want to renovate it, or your tenants may have been in breach of the lease, or there may be rent arrears. So these are all sufficient grounds to be able to serve notice. If your tenant has been in the property for less than 6 months, you can serve notice at any time in that 6 months, and you only need to provide 28 days notice. If they've been in longer, then it's likely to be 84 days notice you need to give to your tenant. But again, that could vary depending on the ground that you're using. So if you have a ground to serve notice, then yes, you can regain possession of your property. If the tenant doesn't move out, then you would look to move forward to evict the property, evict the tenant from the property, and you would do that through the first tier tribunal. So that's a system that's here in Scotland that is free service. It's available to landlords, to tenants, to agents, and they will act on your behalf. They will review your submission for grounds for eviction, and if they agree with your request, they will then refer to the sheriff officer or the bailiff to remove the tenant from your property. So they will grant that order and instruct that to happen. That process will vary in length depending on the current caseload with the tribunal, and it could be anywhere between 6 weeks and 3 months, but they will act on your behalf. As I say, it's free of charge. So if you do get to the eviction stage, you have got that service there to use. But initially, the notice periods, then yeah, as long as you've got a ground, then that's pretty straightforward. Hopefully
Brilliant.
that covers it.
Thank you, Nikki. The next question's for Stephen. This person is buying a 2-bed flat for their student granddaughter, and they want to rent the other room out to their student friend. What type of rental agreement does this person need under Scottish legislation, and can this be done on a short-term academic year basis?
Okay, well, first things first, what wonderful grandparents buying their granddaughter a property like that. Superb. Granddaughter's probably thinking, you dancer, party central, whereas grandparents are thinking this is going to enhance a learning experience. Grandparents, don't be too upset you're entering into a fairly decent investment as a result of that. Nikki's already provided the answer to this question. It's a private residential tenancy that you have to enter into, and it's open-ended. So it can be for the academic year, but that would need to be with the consent of the tenant to bring that to an end at the end of the academic year. But yeah, that's the answer. The answer is it's a private residential tenancy, and it can be for an open-ended, it is for an open-ended period, and it would be brought to an end with the consent of the student involved. So there are other ways to bring it to an end. Nikki mentioned the various reasons there, but generally speaking, a student's going to want to make a break for freedom at the end of the academic year anyway, and so practically that's generally what would happen.
Brilliant, thank you. Paul, the next question's for yourself. Can you purchase a buy-to-let as a first-time buyer, and what is the minimum loan-to-value for buy-to-let?
Yes, the answer to that question is yes, you can. You can actually buy a buy-to-let as a first-time buyer. Although in saying that, the amount of lenders that will offer this actual facility as a mortgage are very, very, very limited. I think there's only something like 3 or 4 lenders that will actually allow you to do this. You will need a 25% deposit, just like you would normally under normal buy-to-let circumstances. It's a first-time buyer. That's certainly the case anyway. That's basically the answer to the question. I can't really elaborate on that anymore.
Brilliant, thank you so much. Stephen, the next question's for yourself. In the current regulatory climate, is it better to use a company structure? Does it make sense to move to personal buy-to-lets in a company structure?
Okay, well, if we discount the desire of some folk to just want to call themselves a director as a valid reason for incorporating a buy-to-let business, the decision to incorporate is generally taxation-led. So the first thing that I would say is to take accountancy and taxation advice first of all. The accountant will know your personal details and will be able to give you bespoke advice in relation to whether it's a good or a bad thing from a taxation perspective. Generally, speaking in relation to taxation, your personal allowance for tax is £12,570. And if you have a personal buy-to-let business, you're going to be taxed at a higher rate depending upon what your personal rate of tax is. Whereas if you incorporate your business or you start with a company, you will pay corporation tax. So you could, on a personal level, end up paying up to 46% tax, depending upon what you earn, as opposed to corporation tax, which is a flat rate, 20%. So there are significant savings to be made in relation to the income that you receive in that regard. There are additional benefits to incorporating or to transferring to a company. A company is a separate legal entity, and as such, if the business fails, because it's a separate legal entity, it's the company that suffers the consequences of that rather than yourself as an individual. So if you've got the properties in your own name, things go wrong, they become repossessed, they come after you, banks come after you for the balances that are left over, you have issues in that regard on a personal level. If that happens with a company, then it's the company that suffers the consequences and not yourself. And therefore, that is viewed as a significant benefit to entering into a company structure. If you want to sell the business, if it's a company, then you're selling the shares of the company rather than having to transfer the property by way of a disposition. And as anybody who's bought or sold a property knows, the only people that win in those circumstances are solicitors. So happy to do that for you if you want to, but if it's in a company, you're doing a transfer of shares, and that is significantly easier. You could always do transfers of shares, and that's a straightforward thing to do within family circumstances. If you want to transfer shares to other members of your family for tax purposes and all that type of thing, I'm sure your accountant will be able to give you advice in relation to that point. There are some disadvantages. The major disadvantage, I would say, one of the major disadvantages is that everything needs to be lodged with Companies House. So whilst this provides transparency, and that's part of the set-off against being given limited liability, it does mean that the annual accounts and all of the other information with regard to the personnel within the company are able to be inspected, as one of my elderly relatives said recently, on the line by anyone. So they can go online to Companies House, check what you're earning, check what the company is taking in, check what the company balances are, and get information with regard to your business. And you may or may not like that, depending upon your own personality. That's up to you. There's also a lot more paperwork involved with the company. You've got corporation tax returns. You've got to inform Companies House within specified statutory deadlines of various changes that you make. You've got to file accounts within various timeframes. All of these things are could be viewed as disadvantages. As Paul will tell you, the mortgages that are available to a personal buy-to-let investor are maybe different to those that are available to a company. I'm not saying that's better or worse, just different. And a lending to a company would normally, depending upon what the company's assets are, would normally be accompanied by a request for a personal guarantee by the director or shareholder, depending upon the loan to value ratio. But Paul, I'm sure, would be able to talk you through that type of thing. Transferring, to go to the question with regard to transferring from a current buy-to-let business, that would require, depending upon the number of properties, a asset transfer agreement to be entered into between the personal buy-to-let business and the company. And that could potentially, depending upon the figures, trigger a capital gains tax liability. So if a capital gains tax liability is triggered, you need to factor that into your calculations as to whether or not it's a good, bad, or indifferent thing to do. There are a number of additional taxation issues about how you take your money out of the company, about what happens when people die in their shareholdings. But the scope of this seminar, or webinar rather, is probably a bit too narrow in order to go into that today. But yeah, it could be a good thing. There are significant taxation positives to that, but there are negatives, and it's not something that you do thinking that the grass is always greener on the other side, because sometimes it's not. Okay, hopefully that helps answer that.
Brilliant. Thank you, Stephen. And just to let you all know, this is the last of our pre-submitted questions, the one I'm going to ask Nikki next. Sorry. So if you do have anything you want us to expand on, or something we've not covered that you'd like us to, please do so now. I can see a few of them are coming through already, so thank you for doing that. So the next question is for Nikki, of course. Is there anywhere outside of Edinburgh that you recommend investing in for buy-to-let?
Thank you. So really, the information we predominantly deal in Edinburgh, and the information that I have is basically based on the data that we have for Edinburgh, but I have got some figures that I can give you for different kind of areas that will give you an indication of how other cities are performing. So this is kind of based on the average rent, average time to let, and kind of postcode areas and what their gross yields are. So that's the gross yield is your rent or what you receive before any deductions. What I don't really have is data on the capital growth of a property. So this is really just based on your yield in terms of the rental. So these are actually figures that are based last year, but I don't think should have changed dramatically. But to give you an idea of what's happening in Glasgow, the average rent in Glasgow is 974 a month, and the average time to let is 9 days. So we're seeing the area with the best gross yield is G5, which I believe is the Gorbals area. I'm not sure, but I know that there certainly has been a lot of recent development in that area, and that's been kind of really redeveloped. So there's quite a lot of new housing in that area, and that might be what is as a result of pushing that kind of postcode area. But the gross yield that you can expect for that area is 6.4%. Same figures for Aberdeen. The average rent there is £714 a month. Slow in terms of time to let, which is 33 days, which is considerably longer than other areas. But the best area there, postcode area, is AB24. Which I believe is quite central, although I'm not entirely sure. And the gross yield there is 7.3%. So good gross yield, but slower to rent. So you might have to factor, are you going to have a longer void period? And during that void period, obviously you have no income, you're responsible for maybe council tax, utilities, things like that. West Lothian, average rent there is 769 a month, and the average time to let is 13 days. Best area offering a yield of 7% is EH48. And then Dundee, the average rent there is £675, an average time to let 15 days. And the best area there is DD3, which is offering a yield of 7.3%. So those are kind of the main areas that people would ask me outside of Edinburgh, just to give you an idea of how that compares to Edinburgh, kind of the current figures at the moment in terms of just yield. The best area, if you were considering investing in Edinburgh, is for EH4 postcode, and that kind of spans from Stockbridge, Comleybank, Granton, all the way out to kind of Barnton and Cramond. And a 2-bedroom there at the moment is offering you 7.1%, and it probably has the quickest time to let of just 7 days. So the occupancy certainly is higher in Edinburgh, although there's good yields to be had elsewhere.
Brilliant, thank you. And thank you for the pre-submitted questions to those who gave us them. The next wee section is just going to be the questions that we've received at the moment. So our panelists, please feel free to jump in where you guys feel necessary and where you can provide some insight. We will do our best to answer them as thoroughly as possible, but of course, some questions may require a little bit more research. So in that instance, we can get back to you via email, and please do follow up with us for that. So the first one, this couple seem to have bought a property using a first-time buyer ISA. They've lived in it for just over 2 years, and they're looking to move abroad for a year. Can they rent that out? Their property.
Paul, I think is that in relation to the type of mortgage that they have, meaning it's going to be going from a residential to a buy-to-let? I think maybe is that what?
Well, if they've got a mortgage on it, they can rent it out, and the first port of call on that one, if they have a residential mortgage on it, is to go back to their existing lender, whoever that may be, and ask for a consent to let. Now, it depends again on the lender and whether they'll grant you this or not. But if you're moving abroad, some lenders don't like that. So you would then have to do what's called an international buy-to-let remortgage, which sounds complicated and it kind of is sort of complicated. I hate to tell you that, but it
But
is.
not in Paul's hands, clearly.
Yeah, well, yeah. I mean, it is a specialist kind of mortgage. But however, the likes of your kind of bog standard lenders like Halifax, NatWest, they're usually pretty good with this sort of thing. And they normally allow you to actually just get a consent to let. Some lenders charge like £100 for this. Halifax, for example, just using that as one lender, don't charge anything. It depends on criteria. They'll ask you to complete a application form. It's not long-winded. It's like 1 page. And it does depend again on your rental, you know, things like that. Your salaries don't really come into it, really, to be honest. It's more the rental. So it's a difficult question to answer, but it does depend on the lender and if you can get consent to let or not. If not, then it would be international BuytoLet and remortgage.
Brilliant, thank you. The next question, I believe Nikki kind of touched on this, but this person would just like advice. They are currently experiencing a difficult tenant. So what advice would you give in that instance?
It depends why they're being difficult. Generally, people are being difficult maybe because they're not paying their rent, or they're not looking after the property, or maybe they're not responding to a landlord. It depends, I guess, if the landlord is managing themselves or if they're using an agent. If they are using an agent, then you should be in regular dialogue with your agent to find out what they're doing to resolve this. If it's something that you are looking after yourself, speaking to a tenant or getting a tenant to respond, if they're just not responding, is really difficult. You can only, kind of ask them to reply or respond so many times. There have been kind of, obviously, over the past couple of years, restrictions on being able to visit the property. These have now lifted, so we can visit the property. So what I would suggest is, if you're not getting any response from phone calls or emails, is to contact your tenant and let them know that you're going to visit the property. You need to give them at least 48 hours notice in writing, but then I would pay a visit to the property to see if you can set up some form of dialogue and get things moving from there. If you are getting nowhere, then you, as I say, can serve notice on your tenants, depending what the issue is. If they are in rent arrears, essentially, before you can serve notice, they need to have been in arrears, or they need to be in some arrears for at least 3 months. Before you can serve notice. Other issues might be they might be breaching the tenancy, they're doing things or they're not doing things that they should be doing. So again, that can be grounds for being able to serve notice. So I think the next course of action, if they're not responding to you either by phone or email, is to let them know that you're going to go around and visit the property, see if you can get some dialogue. If not, then you're looking at serving them notice. And if needs be, and you get to that stage, the first tier tribunal will help you should you need to evict them.
Perfect, thank you. And the next question is the one that popped up on the chat box. This person's asking if the panel can say anything about the differences in the buy-to-let dynamics between period properties and new developments. For landlords, is it either more attractive or is it horses for courses? I don't know if I've read that right properly. That's the phrase that I've not understood. Does anyone have any advice on that?
I think it is horses for courses. I think in terms of, oh, sorry guys, I can answer this if you want. In terms of demand, so we've got tenants that are looking for both period properties and new builds. So in terms of a new build for a tenant, they're often more efficient, so their utility bills may be lower. They often come with parking or lift access, and all of those things are attractive for tenants. And then we've got other tenants, particularly tenants that are moving from outside the city, who just want to be in a period property and enjoy all the lovely things that an Edinburgh period property has to offer. So in terms of the demand from tenants, certainly enough from both. In terms of the perspective from a landlord, if you're buying a new build, it's likely going to have a factor. So you would need to pay a factoring fee. So that's essentially paying somebody else to look after the building and to deal with any communal repairs. So it's worthwhile finding out how additional that cost is going to be. And then, of course, for a more period property, you don't have anyone looking at the communal kind of repairs. So if there is, you know, an issue with the roof, then you kind of all the owners have to resolve that themselves. So sometimes that can be a little bit of a kind of a hardship, if you like, but nothing that can't be kind of be resolved, to be honest. So it's whatever kind of works best for you. I know that quite a lot of investors that I've been dealing with recently are finding the new developments an attractive option in terms of them being a fixed price. So, you know, they're not losing out maybe, you know, by having to go offers over. And then other people are feeling they're maybe getting a better deal if they're going offers over because has a new build price been inflated to cover. So it's kind of what works for you. But in terms of them being able to be rented, either, there's enough demand for both. Yeah.
Brilliant. I've got another question, and I think it's one that, Paul, you maybe covered a wee bit earlier, but I'll ask it again, see if there's anything you'd like to add. Would it be possible to get a buy-to-let mortgage if your salary is just under £25,000, but you can put down a large deposit? Also, how easy would it be to transfer a second residential mortgage to a buy-to-let property?
Right. Sorry, I just want to go back to the first part. There's two parts to the question there. So the first one is, could you just repeat? Sorry, there was quite a long
sorry,
question.
of course.
What to do is repeat the first part of the question first. I'll answer that.
Okay. Would it be possible to get a buy-to-let mortgage if your salary is just under £25,000 and this person is saying they can put down a larger deposit?
Yes, definitely, without a shadow of doubt, as long as you're not a first-time buyer. If you are, then that's going to be tricky. If you're not, there's a lot of lenders nowadays that have no minimum income stipulation. So that's quite straightforward, really. And it doesn't matter if you don't have a bigger deposit, you can still have the 25%. Again, it's down to what you can get as rental as well. I alluded to my first sort of comment on the previous two questions. So yes, the answer is yes, absolutely.
Fantastic.
Second part of the question?
Yeah. How easy would it be to transfer a second residential mortgage to a buy-to-let property?
A second, yes. So what I'm assuming there is on the second residential, they don't currently live in it, I would imagine. So if they don't, then that is quite straight. In fact, that's really straightforward because all you're going to do there is do what we call, again, a buy-to-let remortgage. Because if you are living in it and you've got a residential mortgage, that's fine. If you're not living in it, excuse me, and it's a residential mortgage, you are actually supposed to change it to a buy-to-let in any case. So that's quite straightforward as well, depending again on what you can get as a rent. That's it's all, the salary is fine. Some lenders, yes, want 25 grand or more as a salary. Some want no minimum income. But the key to all this is how much rent can I get from this property? Because there's a fancy calculations that lenders use to determine how much you can actually borrow.
Brilliant. Thank you so much. And I believe this is our last question, if none other come through. And this one is touching on the question answered by Stephen earlier. So I believe it's the lady who's buying a flat for their granddaughter. Can I rent the flat to the granddaughter at a national rent and get her to enter time-limited lodging agreement with other students as flatmate under the government rent-a-room scheme? Please let me know if you'd like me to repeat that. I don't think I said that bit as fluently as I've written it.
I think maybe national is notional, and that makes sense. The honest answer to that is I've not really come across the rent a room scheme. I don't know, Nikki, have you come across that?
No, it's not something that we only rent a property as an entirety. I think, Paul, you've maybe had a bit more.
I know a wee bit about rent a room. A little bit about it. You can do it. Lenders are okay with it, actually. And all I know really is, and I haven't checked this for quite a while, but my understanding is that the person who rents the room, the homeowner, is allowed up to £7,500 tax
I know
free.
that, yeah. It's
Yeah,
7.5,
yeah.
yeah.
So as long as you don't break that tax rule, then obviously you don't pay tax on it. That's about as much as I really know on it. It's not something lenders bother too much about. You are allowed lodgers. Usually when somebody tells me, when they come to speak to me about a mortgage, they say, well, I might get a lodger, and I say, well, yes, that's totally up to you. There are a couple of lenders that are funny about it, but you wouldn't normally get a lodger in right away anyway. You would probably do it after you move into the property. And to be honest with you, you are supposed to tell the lender this, but they usually are quite absolutely fine with it.
With regard to the fixed nature of it, my feeling, and I would have to look this up, and I'm happy to do that, but my feeling is that it would still need to be under a private residential tenancy. I don't think that there's two separate scenarios here. I think it's a private residential tenancy that you would have in relation to your rent a room, and you would still have to have that, and then you would have the termination provisions that a private residential tenancy would have. So I don't think that gets around the fixed term nature of the question. But as I say, full disclosure, I'm not 100% sure on that. That's something that we need to check, but that's my feeling in relation. I don't think we have a duality of tenancy regulation in Scotland. I think it's the same one. So
yeah, I would just kind of comment on that, that if the grandparents are buying the property, they are not going to have the lodger, they are not going to be renting the room. So they are going to be renting out the property. Therefore, as Stephen said, really you're back to the private residential tenancy. It's not the grandparents' home that they're renting a room out in. So yeah, it really would be my understanding would be the private residential tenancy, I think.
I suppose the way around that would be for the grandparents to gift the money to the granddaughter to buy the property in her name, and then she could do it that way. But grandparent, it's one thing, grandparents buying a property in their own name and having their granddaughter in it. It's another thing putting it into the granddaughter's name with everything that comes along with that. So I would think very carefully about going down that route.
Brilliant, thank you. So we've got time for just 2 more questions before the webinar finishes. This question is, would it be possible for elderly parents to stay in a buy-to-let property? It's pretty vague.
Yes, is the short answer to that. Yeah, elderly parents can stay in a buy-to-let property. Depending upon what the nature of the buy-to-let is. I mean, would they be actually paying rent? Is it a property? We need to know more information, but is it a property that the son or daughter owned? Is it a standalone buy-to-let property owned by somebody else on a commercial basis? The answer is yes to all of that. But it depends on the facts and circumstances.
Thank you. The final one, when it comes to ongoing costs of buy-to-let, how much should we budget, for example, maintenance, non-let periods, and other ongoing bills?
So it will depend maybe on how much your rental income is, and if you're able to have at least kind of 2 months rental income in hand, then that would be great. But depending on how much your rent is, that might not be enough to cover any major maintenance issues. So the largest issue that we come across is, the boiler needs to be replaced, and that's at the moment at least going to cost you in the region of £3,500. So if you were wanting to have that as a cushion, certainly that's likely to be your biggest singular expense that might happen. In terms of void periods, at the moment, we would say that you have 11 out of 12 months occupied. So again, having a month's rent in hand as backup should keep you going. And then kind of other ongoing bills. So your tenant pays utilities, gas, electric, council tax, phone, broadband, all of those kind of things. So what you would pay on an ongoing basis as the owner of the property is obviously your mortgage if you have one. You should have insurance for the building. You may have to pay a factoring fee if you're using an agent, then their management fees, and then things like regular Safety checks are required. Annual safety checks are for the gas. The electrics are every 5 years. Smoke alarms are every 10 years. So you should have, I would say, 10% maybe of your income as a backup. But those should be a rough idea of what you should be expecting to happen. And as I say, the biggest expense generally seems to be a boiler. So if you've got enough to cover that, then you should be okay.
Brilliant. Thank you. Thank you for all the questions, everyone. We really appreciate it. And if there's anything you'd like us to expand on or get back to you, please just email myself at marketing@espc.com, and I'll forward you to the correct person. That's all we have time for today. Once the webinar has ended, there will be a prompt to fill out our survey. Please do so, because it means we can tailor these to exactly how you would like them in the future. Of course, thank you so much to our panelists for fantastic answers and your time today. And thank you to everyone who came along and watched and took part. All right. Thank you so much. See you
Thanks so
later.
much.
Thank you.
Bye. Bye.
Bye.